This video is about choosing your travel business entity, and I'm Joni Ogg. Since everyone's financial situation is different, there's no one correct answer for everyone regarding the best business entity for travel businesses. The best and only person to advise you as to the right business for your travel business is an attorney and/or an accountant competent in such matters. And before you start your travel business, you should visit with both an accountant and an attorney. Decisions that you make when starting can affect you from a tax and a liability perspective and need to be dealt with properly. While it has cost you some money to start with to seek this advice, it's money that's well spent. So here are some key issues to discuss with your legal and tax professionals. The first is control. If you are a one-man or one-woman business, what happens to your ability to control the business under the various business entities? There are many decisions that you will need to consider, as each business has its positives and its negatives. How about liability? How exposed is the business you decide to use to lawsuits, and how much might it affect your personal assets? How does it affect your business assets? Given your specific financial position, what protection would your legal or tax professional suggest you take to protect yourself from loss based on litigation? And then there's taxation. Each business is taxed differently. What is the impact of the one you choose to have on your taxes? What is the cost of complying with accounting standards imposed by or what they're going to be? What is the additional cost of filing tax returns going to be? Many professionals like the use of subchapter S corporations, but be sure you completely understand what the true costs of operating one are. And then there's survivability. What happens to the business when you might pass away? What are the issues of providing for the business distribution in your will or your trust? Survivability of the business is critical if you intend to leave it to someone in your family or if you want it sold. Now, this article is meant only to introduce you to the various types of ownership options that you can discuss with your financial advisor and/or attorney. Each form of ownership has benefits and drawbacks and also may have unintended consequences. So let's take a real brief look at the options. Now, this is by far the easiest to engage, and that's the sole proprietorship. All you have to do is declare your business and operate it as such. Each state may have different requirements for establishing a sole proprietorship, so it's important to have your attorney or accountant advise you on the requirements. Now, some of the positives are it's easy to set up, easy to operate. You can file a Schedule C tax return along with your personal return and pay taxes on the profits as current income. And you can protect the name of your sole proprietorship and hire as many employees as you would like. On the negative side, there's no liability protection in case of litigation. You could lose everything. May look less professional than other options. You will pay self-employment tax on your entire income, and it's very difficult to raise money as a sole proprietor. Now, partnerships are easy to establish, but many times much more difficult to dissolve. Again, each state may have partnership laws unique to that state, so be sure to have your attorney involved. Some of the positives are you can gain the benefit of different views and experience. You can file partnership tax returns, and distribution of products to partners is taxed as current income. It's easy to get started and less formal with fewer legal obligations. And more partners can generate more capital and more knowledge. On the other side, partner disputes can cause the partnership to dissolve. Additional costs to file a partnership tax return are involved. No liability protection, and each partner is liable for all partners' actions. Now, while partnerships are easy to establish, they can be very difficult to terminate. Limited liability partnerships are usually used by professionals to limit the individual partner's liability for business debts. On the positive side, it offers partners some liability protection from business debts. It can be formed easily from a partnership. You can file partnership tax return, and distribution of products to partners is allocated by the percentage of ownership of the LLP. Individual partners are responsible for their income and their self-employment taxes. On the negative side, it has a limited lifespan. It can offer partners limited liability in most cases. It doesn't protect partners from liability for negligence on behalf of the partnership. One partner can bind all of the others, and LLPs are not recognized in every state. LLPs are limited to certain professions as well. Limited liability company. Now, they differ from LLPs in that they act more like a corporation than a partnership. LLCs are used by many travel agencies. Some of the positives are the liability is the main reason to use one. It protects all of the owners of the LLC from losing their personal assets due to litigation. Again, taxes are passed through to the individual owners and are taxed at current income rates. If there are multiple owners of an LLC, there is a maximum flexibility in terms of management, and LLCs are relatively easy to create and maintain. On the other side, possible loss of control of your business and possible tax ramifications on the market value of the assets if converting another established business into an LLC. Single-member LLCs may be set aside, especially if it is a man and a wife, by the IRS. So LLCs are generally dissolved when one of the members leaves, goes bankrupt, or dies, and the remaining members are responsible for the obligations of the LLC. A subchapter S corporation has all of the benefits of a corporation in terms of liability and perpetual existence. And they also offer interesting tax opportunities, as you can put yourself on a salary and then take out the additional profits as a distribution not subject to payroll taxes. This is one of the main reasons to go with an S corp. This is a great choice if your agency is doing quite well. On the positive side, it's not taxed at the corporate rate, and profits pass through to the owners and are taxed at their personal tax rate. Once a year tax filing, not 4 times a year as in a corporation, and you enjoy limited liability as well. S corps are recognized in all 50 states, and courts uphold the promise of no liability. S corps survive the owner's death, and S corps are perfect for successful travel businesses. On the other side, cost of creating and maintaining a subchapter S corporation is more. There are also might be closer scrutiny by the IRS than with an LLC. You definitely should consult with your tax professional before starting an S corp, as there are several considerations that may impact estate planning, appreciating assets, and other tax and other legal elements. Also, each state has different requirements and fees. As an example, California has a franchise tax fee of $800 today and a corporate California source income tax today of 1.5%. Corporations are used by many to limit liability and ensure survivability upon death. Positives are that corporations enjoy limited liability from litigation and judgments. Personal liability protection is one of the main reasons businesses choose to incorporate. Corporations have an excellent perpetual existence, and transfer of ownership is easy to accomplish. They may also have some tax benefits for non-distributed profits. Corporations are ideal if you intend to raise capital or intend to go public to offer shares of stock. On the other side, corporation profits are taxed twice, once at the corporate tax rate and then when the profits are distributed to owners and employees at their personal tax rate. Corporations are much more regulated than other forms of ownership. And since corporations must use the accrual method of accounting by law, the cost of keeping records is considerably higher than other forms of ownership. Corporations also have rigid formalities, protocols, and regulations that must be adhered to, which drives the cost of operating a corporation up, making corporations the most expensive form of business. Once again, as an example in California, with a franchise tax fee of $800 and state of California tax rate of 8.84%, and this on top of California's personal income, makes it operating a C corp in California rather punitive, to say the least. So you can easily see there's a substantial amount to consider when you're choosing your business entity for your travel agency. Be sure to seek the expert advice of an attorney and/or accountant before making your decision. Don't think that you can't change your business as you grow, as you most certainly can do that. A natural progression might be that you start as a sole proprietorship, and when the business starts performing nicely, you might change it to an LLC. And then, once the business is doing really well, change it to a subchapter S corporation. Thank you so much for watching this short tutorial. We hope you've enjoyed it. Why not give it a like or a share? And if you'd like to know when we release future tutorials, just subscribe to our channel.